right, folks, we're going to shift a little bit, get back to the economy. Joining us now, Michelle Girard, chief U.S. economist at Natwest. Good to see you, Michelle. I mean, seriously, does anybody know what's happening in the economy? Inflation, sticky or slippery? Recession or expansion? Labor? I mean, I'm asking a very serious question, so only you can inform us.
I mean, we are seeing mixed data. So as is often the case, you can make any story that you want. We saw that with last Friday's employment report. There was enough in there for those who think that the economy is softening up to point to the increase in the unemployment rate, the drop in the household number of people employed. But there was also obviously a very strong headline gain and a lot of corroborating evidence in other labor market indicators. So again, I think you know, in the moments of the day in and day out of the data, you can craft any story. But stepping back and looking holistically, I think there are signs that both inflation and the economy are slowing down.
Yep.
And the Fed has done an awful lot.
Yep.
And monetary, stimulus is being removed, has been removed at a significant rate. And I think that's all going to come home to roost. So whether it comes, the downturn comes in 2 months, in 3 months, 6 months, I think that what we know is that I don't think we're going to get out of this. We're not going to get inflation down to where the Fed wants it to get to without a downturn.
Without a downturn. I mean, this is the most widely heralded recession in the history of the economics profession. But the economics profession sometimes, a lot of times, doesn't know what it's doing. I mean, do we have to destroy, you may be right, but do we have to destroy the economy to get inflation down, for example? Do we?
Well,
is that necessary? I mean, people with jobs taking home pay is not a bad thing.
It's not a bad thing. And I don't mean to suggest that I want to see the economy have to go into a downturn, but we have enjoyed there's been so much money, and everybody has gotten quite used to being flush with cash. And I believe that has put into place a mindset that has allowed inflation to take hold in a way that it hasn't for decades. And I don't think, I mean, you look around even just anecdotally, you think about your own experience. I mean, restaurants are crowded, stores are crowded, and it's hard to envision a scenario where there's going to be enough pressure against, for prices to come down without some sort of something to sort of pull back, to lead to a pullback in demand to some extent.
So the Fed, in this view, the Fed keeps tightening, raising rates?
Well, I think, but again, the Fed has done a lot already.
Yeah.
And so actually what we're seeing now, I think are the steps that have needed to take place. I don't think they have to do more. We've been sort of wrong because we didn't think they would have to go in May. We don't necessarily think they have to go in June. Likely it seems they're signaling they will skip in June, go in July. I mean, if you think you have to go in July, why not just go in June and be done with it?
I'm going to give you a quick quiz here on here, spontaneous quiz. Monetary lags are long and variable. Who said that?
Well, Milton, but you.
Milton, taking from Milton.
Yes, but you taught me that.
I mean, that's the thing, though. What they've done hasn't really impacted that much yet. That's the last word. I mean, will it?
I think it will. I mean, those long and variable lags can be 18 months. And to some extent, the contraction that we're seeing in the banking sector is the product of what the Fed has been doing for over the last year. So I do think that we are seeing some of the effects, and it will only grow.
I got to get out. Akio is screaming at me. Producer screaming at me. Michelle Girard, good wrap up. We appreciate it.